Welcome to our YouTube channel where we bring you insightful book summaries to help you expand your knowledge. Today, we'll be exploring Howard Marks' incredible work, The Most Important Thing. Howard Marks, known for his financial expertise and investment insights, delves into the core principles of successful investing in his book, The Most Important Thing. Through this engaging read, Marks shares valuable lessons and philosophies that can help readers navigate the complex world of investments and decision-making. So, let's dive into the summary of this incredible book. But before we dive into the content, I kindly request a moment of your time to appreciate this video by liking it, subscribing to the channel, and ringing that notification bell. Your support means a lot to me. Thank you so much. The Most Important Thing by Howard Marks is a thought-provoking book on investing. It offers valuable insights into the mindset and approaches of a successful investor, with a focus on risk management and the importance of contrarian thinking. In The Most Important Thing, Howard Marks outlines the sometimes controversial investment philosophy that he developed and honed through many years of market experience. In his view, successful investment requires us to pay thoughtful attention to many different aspects of the current market, and too often use that information to counter the predominant trends. The Most Important Thing by Howard Marks is an insightful exploration of the key principles to successful investing. Here are 3 reasons why this book is worth reading. Through practical wisdom and valuable insights, the book provides a comprehensive understanding of the complex world of investing. Marks effectively highlights the importance of controlling risk and understanding market cycles, offering invaluable knowledge for investors. By sharing personal experiences and case studies, the book engages readers and illustrates the practical application of the concepts, making it anything but boring. Here is a sentence showcasing the greatness of a quote of this remarkable book. "Investing, like economics, is more art than science." Howard Marks. Those are the individuals who truly deserve to immerse themselves in this remarkable book. Anyone who wants to earn a profit through investing. Anyone who wants to understand how financial markets work. In The Most Important Thing, Marks emphasizes the importance of understanding risk and managing it effectively. He argues that risk is an integral part of investing and should not be overlooked. Through insightful anecdotes and real-world examples, Marks illustrates how successful investors approach risk assessment and decision-making. Moreover, Marks discusses the significance of mastering market cycles and recognizing when asset prices deviate from their intrinsic value. By examining market trends and investor behavior, readers can gain a deeper understanding of how to capitalize on profitable opportunities and avoid common pitfalls. Another fundamental lesson shared in The Most Important Thing is the concept of contrarian thinking. Marks stresses the importance of questioning conventional wisdom and avoiding herd mentality in investing. By taking a contrarian approach, investors can uncover undervalued assets and position themselves for long-term success. To the outsider, the world of investing can seem daunting to enter, if not outright impossible. But according to investment professional Howard Marks, anyone can learn the basics needed to invest successfully. In his 2011 book, The Most Important Thing, Marks outlines the key tenets of his approach to investing. He argues that the best approach for investors is value investing, which involves determining securities' intrinsic value and purchasing below it. To practice it successfully, you must learn the nature of market cycles to find opportunities for purchasing mispriced securities, while also learning how to mitigate the risk entailed by investing. In this guide, we'll outline the fundamentals of value investing, discuss market cycles and how they're useful to the value investor, and analyze the common mistakes that often leave investors exposed to unnecessary risk. Throughout the guide, we'll also examine recommendations from other investors that supplement and occasionally challenge Marks's investing wisdom. Exploit investing cycles to increase returns. Though cycles can ensnare novice investors looking to turn a quick profit, they can also provide lucrative opportunities for savvy investors. To that end, Marks argues that investors can generate outsized returns by taking contrarian positions at cyclical extremes because securities are significantly mispriced at these extremes. Taking contrarian positions is a key component of what's more generally known as contrarian investing, in which investors buck widespread investing trends that they believe are ill-founded. Such renowned investors as Benjamin Graham, author of The Intelligent Investor, and Warren Buffett, the Oracle of Omaha, are considered contrarians. At a broad level, Marx notes that at any given point in a cycle, most investors' views about the market will reflect that phase of the cycle. For example, in a bull market, most investors will be optimistic, leading them to frequently buy assets and drive up prices. Otherwise, there wouldn't be a bull market to begin with. However, Marx points out that acting in line with the consensus can only lead to market average returns by definition. After all, if you invest the same as the majority of investors, you won't be able to outperform them. Harmful institutional incentives to avoid looking foolish might offer one reason why so many investors follow suit with cyclical trends. In The Signal and the Noise, Nate Silver argues that professional forecasters' reputations can suffer if they incorrectly oppose the consensus view, inclining them to make conservative predictions that, when incorrect, are less embarrassing. So, in a similar vein, investors might hesitate to buck mainstream trends because the embarrassment of mistakenly betting against these trends is much greater than the embarrassment of mistakenly betting in line with these trends. Consequently, Marx concludes that acting contrary to the majority of investors is necessary for above-market returns. Specifically, he contends that contrarian investing is most powerful when cycles reach extremes. For instance, purchasing securities at the peak of a bear market, when prices are about to rise, or selling securities at the peak of a bull market, when securities are about to drop. Nonetheless, he admits that contrarian investing isn't always advisable. After all, for large portions of investing cycles, there aren't widespread discrepancies between price and value. So, Marx recommends that investors base contrarian decisions on rigorous analyses of intrinsic value to maximize their chance of finding market errors. Although Marx advocates for contrarianism on the grounds that it can yield above-market returns, it's worth emphasizing that market average returns would actually place you better than the majority of investors. In fact, while the S&P 500 averaged annual returns of about 6% between 2000 and 2020, the average equity fund investor averaged only 4.25%. Experts point out that this disparity occurs because investors often buy when the market is high and sell when it's low, leading to below-market returns. Additionally, John C. Bogle argues in the Little Book of Common Sense Investing that many investors earn below-market returns because they invest in mutual funds with high turnover rates, which charge fees that cut into their profits. How to mitigate investing risk. Even rigorous analysis of securities value, however, can't entirely shield investors from risk. On the contrary, Marx contends that risk is an unavoidable aspect of investing. In this section, we'll outline Marx's conception of risk, his warning signs of a risky market, and his recommendations for controlling risk by practicing defensive investing. Marx's view of risk versus the academic view of risk. According to Marx, any approach to investing requires an understanding of risk. He defines risk as the probability that you'll lose money because that is investors' greatest concern. To see the novelty of Marx's definition, it helps to understand the main alternative that he rejects, namely the standard academic view that equates risk with portfolio volatility, the extent to which the portfolio experiences swings in value. As Marx relates, this view is based on the assumption that more volatile investments are less reliable, increasing risk for investors. In the Warren Buffett way, Robert G. Hagstrom clarifies that academics equate risk with volatility because of their reliance on the efficient market hypothesis, EMH. Hagstrom points out that, because the EMH assumes all investing success boils down to luck, proponents of the EMH believe that investors with volatile portfolios are simply more likely to lose money. So, it stands to reason that Marx's disagreement with academics' view on risk stems from his disagreement with their view on market efficiency. In Marx's evaluation, this academic view misses the mark. Specifically, he suggests that investors aren't concerned with portfolio fluctuations per se because fluctuations alone don't always cost investors money in the long run. On the contrary, a security's price might fluctuate wildly, but as long as its price follows an upward trend over time, it can yield large returns. For this reason, Marx clarifies that the real risk of investing is the possibility of permanent loss. Based on his own investing experience, he argues that this prospect most worries investors. Some experts disagree with Marx's claim that investors aren't concerned with portfolio fluctuations. According to experts in behavioral finance, many investors suffer from myopic loss aversion, the combination of loss aversion and a tendency to chronically check their portfolios. As Daniel Kahneman relates in Thinking, Fast and Slow, loss aversion refers to our tendency to weigh losses more heavily than equivalent gains. Thus, when investors suffer loss aversion and chronically check their portfolios, losses from short-term fluctuations can prove psychologically painful. The upshot is that risk can't be objectively measured, and only investors with careful qualitative analysis can discern the risk associated with a given security. In particular, Marx argues that investors must ascertain how stable a security's intrinsic value is, along with the nature of the connection between this value and the security's market price. After all, these are the two factors that determine the likelihood of loss. If a security's value dips, or the market fails to accurately reflect this value, investors will lose money. Although Marx claims we can't objectively measure risk, many professional economists attempt to do just that. For example, some economists measure risk via the Sortino ratio, which measures how a given security's downside volatility compares to the average downside volatility of all comparable securities. However, formulas like these are based on the assumption that volatility equates to risk, a premise that, as we've seen, Marx rejects. Indications of a risky market. Although Marx maintains that risk is immeasurable, he admits that there are warning signs that often indicate the presence of high risk. Specifically, he argues that widespread high prices are indicative of high risk because high prices are a proxy for excessive optimism and risk tolerance. Marx reasons that when prices soar, it's more likely that stocks' prices fail to include a risk premium, which is the difference between a stock's expected return and the risk-free rate of return, typically the guaranteed return from government bonds. For example, if Apple stock started to soar, it's likely that the expected return would drop closer to the risk-free return of a one-year Treasury bond, 4.72% at the beginning of 2023, because prices can't rise indefinitely. According to Marx, this means investors are no longer compensated for the risk they incur when purchasing stocks instead of risk-free bonds, leaving them exposed to more risk without the prospect of a proportionately higher return. Because risk premiums depend on the risk-free rate of return, it follows that the same expected return from a security can yield a different risk premium depending on the risk-free rate at the time. For example, imagine that you could expect a 10% return on Amazon stock at the beginning and end of 2022. At the beginning of 2022, when the one-year Treasury bond offered a 0.4% return, your risk premium would be 9.6%, 10% minus 0.4%. But at the end of 2022, when the one-year Treasury bond offered a 4.7% return, your risk premium would be much smaller at 5.3%, 10% minus 4.7%. Control risk through defensive investing. Though he discourages high-risk investments, Marx recognizes that eliminating risk altogether, for example, by purchasing 10-year government bonds that return around 4% annually, will yield unsatisfying returns. He argues that, to balance this inverse relationship between risk and return, you should practice defensive investing, which uses a margin of safety to reap reliable returns while minimizing risk. As Marx relates, the margin of safety refers to the difference between a security's intrinsic value and its market price when purchased. For example, imagine that you purchased Tesla stock at $118.47 at the beginning of 2023, and its intrinsic value was $150 per share. Then, your margin of safety would be about $32 per share. Graham, who first introduced the concept of margin of safety in The Intelligent Investor, argued that one crucial way to increase your margin of safety is through diversification, purchasing more securities of different types. He reasoned that, even with a margin of safety, investing in only one security leaves you exposed to loss if that security drops significantly. For instance, even with a $32 per share margin of safety when purchasing Tesla stock, a large drop in Tesla's intrinsic value could leave you exposed to a loss if that was your only investment. By contrast, with a diverse portfolio, you'll still be able to earn a profit even if some of your securities drop in value. According to Marx, investing based on the margin of safety has two key benefits. First, as we discussed earlier, securities purchased below their intrinsic value are likely to increase in price because market price typically reflects intrinsic value over the long term. Second, the margin of safety protects investors from loss if the intrinsic value of a security decreases. Returning to the previous example, even if Tesla's intrinsic value dropped to $120 per share, it's unlikely that you'd lose money since you purchased at $118.47 per share. Although investing with a margin of safety has these benefits, experts point out that it also suffers drawbacks. In particular, establishing a margin of safety requires accurately determining a security's intrinsic value, a practice which, experts warn, rarely lends itself to a precise answer. For example, Buffett's method of calculating intrinsic value requires estimating a company's future net income, which is an inherently subjective estimate. For this reason, investors can easily think they've established a margin of safety because of a faulty intrinsic value calculation, leaving them overconfident. Psychological and intellectual pitfalls to avoid. While investing grounded in the margin of safety sounds straightforward in theory, investing is more complicated in practice. As Marx points out, that's because investors often succumb to emotional or intellectual pitfalls when investing. In this section, we'll consider the primary investing mistakes that you must avoid to maximize your success. Common psychological pitfalls. While Marx admits that investing markets might be perfectly efficient if investors were fully objective and rational, he contends that the opposite is true. Psychological influences affect investors' decisions, cutting into potential profits. And though Marx lists an array of such influences, we'll focus on the effects of three key ones: greed, fear, and the desire to conform. Pitfall number 1: greed. First, Marx argues that greed leads investors to make suboptimal decisions as it causes them to abandon caution. He points out that when investors are overcome by their desire to earn money, they cast aside risk aversion in hopes of earning an outsized profit. For instance, a greedy investor might spend an exorbitant amount of money investing in an unproven cryptocurrency, leaving them exposed to massive losses if the investment fails. For this reason, Marx maintains that greed is one of the most potent forces working against investors. Although it's impossible to precisely determine greed's influence, CNN business experts have developed a fear and greed index that estimates which emotions are driving the market. This index relies on 7 metrics, including market momentum, market volatility, and the demand for junk bonds, to assess whether the market is greedy, fearful, or somewhere in between. For example, a high demand for junk bonds, bonds that have a high likelihood of defaulting, suggests a greedy market, while an above-average degree of volatility suggests a fearful market. Pitfall number 2: fear. On the other end of the spectrum, Marx holds that fear causes investors to leave profits on the table because scared investors are unwilling to take even well-informed risks. According to Marx, fear paralyzes the would-be investor. For example, a fearful investor might see an opportunity to purchase a security for far below its intrinsic value, only to be frozen by the possibility that they'll ultimately lose money. In this way, fear can hinder investors from maximizing their potential returns. According to experts, one way to mitigate fear when investing is to start with smaller investments and gradually work your way up to investing larger sums. Because fear is proportionate to the amount of money you've invested. After all, the more money that you invest, the more money that you could lose. Slowly increasing your investment portfolio will help you cope with gradually increasing amounts of fear. Pitfall number 3: conformity. Both greed and fear, however, can result from a greater problem afflicting investors: the desire to conform to other investors' behavior. Marx argues that conformity often leads investors to act irrationally when the consensus view is misguided, as it often is. Specifically, he contends that pressure to conform causes investors to forsake their own due diligence when assessing securities and incur excessive risk, as they reason that the consensus view can't be mistaken. In turn, this behavior leads investors to purchase securities that they would never have purchased otherwise. The Warren Buffett way, Hagstrom explains Buffett's idea that conformity doesn't just influence investors, but also business leaders. According to Buffett, these leaders often succumb to the lemming factor and blindly follow industry trends, like constantly acquiring other companies, even when these trends are ultimately irrational. Thus, Buffett recommends investing in companies that are unafraid to look foolish and buck industry trends because they're less likely to mirror these harmful tendencies. Common intellectual pitfalls. While emotions like greed and fear can spell disaster for investors, Marx argues that intellectual mistakes can also lead to subpar investments. Specifically, he contends that investors who are too credulous and those who fail to consider rare outcomes are susceptible to large losses. Pitfall number 1. Excessive credulity. First, Marx maintains that gullible investors often accept delusions that require them to ignore past investing wisdom. For example, you might recognize that investing markets have experienced cycles historically, meaning that peak bull markets often lead to bear markets with their associated price drops. Even knowing this, the credulous investor could become convinced that these past norms no longer apply, causing them to continue purchasing securities under the delusion that prices can only rise. In this manner, credulity can result in excessive risk that leaves investors exposed to potential losses. Excessive credulity in investors might stem from the Otis fallacy, the fallacy of believing something because you want it to be true, not because of evidence that it is true. Informally known as wishful thinking, this fallacy explains why investors might purchase securities believing that their price can only increase, even though historical evidence suggests otherwise. After all, it's natural for investors to want their securities to only increase in value. Pitfall number 2. Lack of imagination. In a similar vein, Marx argues that investors who lack imagination will fail to plan for rare contingencies, leaving them vulnerable to loss when those contingencies occur. He maintains that such investors plan for the future by extrapolating from the recent past, assuming the future will reflect the past. However, this lack of imagination means they won't account for instances when the future does diverge from the past. For example, when the dot-com bubble burst in 2000, as technology companies' stock prices plummeted despite investors assuming that these prices could only increase. Consequently, investors without imagination pay the price when the future doesn't meet their expectations. One possible reason why investors suffer from lack of imagination is that they rely too heavily on what Daniel Kahneman calls System 1 thinking. As opposed to System 2 thinking, which Kahneman defines as our ability to slowly and deliberately form judgments, like solving a complex math problem. System 1 thinking involves quick, intuitive judgments without voluntary effort, like performing basic arithmetic. According to Kahneman, System 1 thinking leaves us prone to extrapolating patterns from data that are actually random, like assuming a coin is rigged because it lands on tails several times in a row. Thus, investors that use System 1 thinking might assume market trends will continue indefinitely on the basis of recent data, although these data are often random subsets of larger datasets. How to avoid these pitfalls? Marx contends that there's no foolproof strategy for avoiding these pitfalls. However, he does offer one main suggestion to investors. Remain keenly aware of market conditions, especially the supply and demand relationship for securities, because such awareness will help you realize when securities are mispriced. For example, to avoid succumbing to greed, you might recognize that capital is flowing too freely into fledgling, high-risk securities in the technology sector as investors hope to find a diamond in the rough. In such a situation, cognizance of this market trend would help you realize that these securities are likely overpriced. Similarly, to avoid excessive credulity, you might recognize an inordinate demand for, say, real estate because investors think real estate values can only increase. By remaining aware of this, you'll be poised to avoid the trap of thinking that past trends about the housing market are no longer relevant. Experts offer a variety of strategies for remaining on top of relevant market conditions like Marx suggests. For example, they point out that following news aggregators, such as Google News, can keep you aware of pertinent investing reports from a wide array of sources to ensure you don't miss market developments. Moreover, they note that social media can provide direct access to the most important pieces of information about securities markets. The most important thing will show you how to understand the current market in order to make good financial decisions and avoid common pitfalls that ensnare so many investors. Rather than offering a manual with step-by-step instructions, these insights outline a thought-provoking and sometimes controversial investment philosophy. In these insights, you'll learn why most commonly held ideas pertaining to the current market are usually wrong, why market forecasts are typically useless, even when they're right, why psychology plays such a powerful role in market cycles, why a dumb financial decision can sometimes make an investor look like a genius. 1. Since opportunities to beat the market are rare, successful investing requires perceptive thinking. If you want to become a successful investor, you need solid grounding in the basics. So let's start with a simple definition. Investing consists of putting money into assets and expecting an increase in value. Taking it a step further, successful investing means buying mispriced assets that are priced too low, selling them later at a higher price and earning a profit. It sounds simple, but mispricings are rare. Why? Because most of the time, there are thousands of participants actively gathering information about various assets and evaluating them diligently. When this thorough assessment is indeed the case, the asset's price doesn't stray far from its intrinsic value, that is, the price the asset is actually worth. And when an asset is priced appropriately, which is typically the case, it's hard to profit from it. Still, in practice, mispricings do occur. For example, in January 2000, shares of Yahoo sold at $237 apiece. But then by April, share prices had fallen to $11. If you had owned the stock, your investment would have suffered massive losses. And how do we account for this sizable fluctuation? Well, the price must have been wrong on at least one of these occasions. In general, mispricings make profits and losses possible in a big way. But as we mentioned, detecting these mispricings is a difficult task. So if your investment goal is to earn higher than average returns, your thinking has to be different and better than everyone else's. This is called second-level thinking, and it works like this. First-level thinking says, it's a good company. Let's buy the stock. Second-level thinking goes beyond the conventional wisdom by saying, it's a good company, but everyone thinks that, so the stock is probably overrated and overpriced. Let's sell. This approach is so effective because it acknowledges the fact that all the investors put together actually make the market. Second-level thinking takes all these other investors into account in order to beat the market, not just submit to it. 2. Understanding the relationship between value and price is the cornerstone of successful investing. The oldest rule in investing is also the simplest. Buy low, sell high. That might seem blindingly obvious until you try to put it in practice. And then you start to wonder what's low and what's high. To answer that, there has to be some objective standard. And for our purposes, the most useful one is the asset's intrinsic value. In fact, coming up with an accurate estimate of intrinsic value is the ideal starting point for successful investing. You would do this by analyzing a company's general attributes, which are called fundamentals. 3. Dealing with risk is an essential aspect of investing. Investing requires us to deal with the future. But since we can't predict what will happen with any real certainty, risk is unavoidable. Investment risk is always present, even when it's hard to recognize. This is especially true when prices are high, since they're ever more likely to fall. High prices are due to excessive optimism and insufficient skepticism that prices will remain high. So perhaps paradoxically, the prime element of risk creation is the belief that risk is low, maybe even non-existent. For swooping in at the bottom of a market cycle yields the greatest opportunities for gain. Although there are very few sure things, when it comes to the world of investments, there are 2 rules we can always count on. Rule number 1. Most things are cyclical due to the nature of humanity. Mechanical things move in a straight line, but humans don't. People are emotional, inconsistent, and mutable. And more specifically, when investors become emotional, it creates cyclical patterns in markets. 5. If you want to make successful investments, buck the trend and seek out unusual bargains. Most investors tend to follow the trends. Superior investors, however, do the exact opposite. In fact, bucking trends is the key to successful investment, because crowds make errors with an almost mathematical regularity, creating insane market turbulence. 6. Since market forecasts are mostly useless, investors should have a good understanding of the present economic situation. If you follow market forecasts, then you know that these investing tools can sometimes be right. However, the key question isn't whether they're sometimes right, but whether forecasts consistently provide actionable and valuable information. 7. To achieve investment success, avoid analytical and psychological sources of error. When it comes to analyzing the financial market, plenty of people are going to follow similar lines of reasoning and reach similar conclusions. And yet, people who arrive at the exact same conclusion often behave differently. That's because psychological factors don't influence everyone the same way. In fact, some of the biggest investment errors come from these psychological factors like greed, fear, ego, and envy. These forces can drive us to pursue high returns by accepting high levels of risk. Investment outcomes often hinge on random events, so find an investment approach that anticipates various scenarios. Every now and then, someone takes a huge risk that pays off. And although it's great to be on the receiving end of such a scenario, it's worth remembering that winning a gamble is the result of luck and boldness, not skill. Indeed, luck plays a huge part in investment. When it comes to the markets, a great deal of success is a matter of being in the right place at the right time. And moreover, success can also entail being in the right place for the wrong reasons. In fact, outcomes often hinge on totally random events. Overall, the most important thing serves as a comprehensive guide for both novice and experienced investors looking to enhance their decision-making skills and navigate the ever-changing landscape of finance. Howard Marks' wisdom and insights are sure to inspire readers to adopt a thoughtful and disciplined approach to investing. You can find the link to acquire a copy of this remarkable book in the description below. Thank you for joining us on this journey through the key lessons of The Most Important Thing by Howard Marks. I hope you guys enjoyed that video. If you found this book summary helpful, be sure to give this video a thumbs up and subscribe to our channel for more book summaries and self-improvement tips to help you achieve your goals and lead a more fulfilling life. And share this uplifting summary with someone who may benefit from hearing them. Leave a comment down below if you've read this book or have any other recommendations for us. And also don't forget to explore our curated playlists of book summaries covering various topics. Stay tuned for our next video where we will be discussing another impactful book. Until next time, stay awesome and keep learning.